exchange may move outside India, then still they have to pay taxes in India, either as per the domestic provision of Income Tax Act, as it says significance economic presence, transaction dealing with resident in India liable to tax in India as per the business connection in India. But as per the DTA, it not tax in India unless until there is a permanent establishment in India. So many exchanges, Bajirex, are moving outside India. They are providing service only peer to peer. They are matching seller contract with the buyer contract. They not doing exchange settlement transaction. So in this scenario, there is, prior to implementation tax in India, there are some uncertainty. Now it is clear what is the tax liability and what is the TDS liability in respect of virtual digital asset. So government is very clear, 1% TDS in respect of buying from resident, and in case you are buying from non-resident, as per section 195, the same 1% will be taken as rate in force. So what is the legality and unlegality in India? As per the CBDT, crypto trade digital transaction do not ipso facto become legal or regular just because you have paid income taxes in India. So legality is some different thing. Suppose as per the India, there is a FEMA concept is there, liberalized LRS scheme is there. You as a person resident in India is allowed up to $250,000 remittance outside India per financial year. So suppose you have already exhausted this limit for your personal tour, children education, etc., then you are not allowed further over and above investment on $250,000 USD. So in that case, FEMA violation is there. So legality, everything is clear. So I advise to exchanges, do not go to outside India. In that scenario, your tax liability would be higher if you become foreign company in India. If you remain resident company in India, then tax liability is much lower. So let us understand why this tax liability will be higher. Exchanges is choosing Dubai, Singapore, Malta, Switzerland and Estonia for their best tax friendly location. That is not a correct thing. In India, future legality of cryptocurrency remain a question, and the proposed tax regime prohibitively high. However, if they are servicing Indian customer from outside India, application of equalization levy is there. GST on import of online services, tax deduction at source, tax base could still be grey area. Still, on the balance, it would be more advantageous to you to be outside in India rather operate through India, within India. So if the crypto exchanges move out their operation outside India relating to sale and purchase of crypto transaction, as it did by the Bajirex, right now, right away, they are providing only P2P, peer-to-peer services. They are matching sale transaction with the buyer transaction. So they are only charging commission. So in that scenario, if Bajirex remain resident of India, your only commission income is liable to tax. And if you provide other than P2P services, then as an exchange you will liable for TDS for buyer and seller. Then the tax liability of income arising from exchange will be decided on the basis of provision under Income Tax Act. Read with provision of DTA of respective country where you operate. So Income Tax Department may argue that these foreign based crypto exchanges facilitate transaction in cryptocurrency for people resident in India. In this regard, Indian Income Tax Department may also realize significant economic presence provision as embedded in Section 911 of the Indian Income Tax Act to says that activity carried out by foreign-based crypto exchanges within Indian investor amount to systematic and continuous soliciting of business activity in India. So as per my advice, you should remain resident in India. As a exchange, you provide services to within the Indian soil. You don't need to go outside India. If you go outside India, then POEM, place of effective management provision is there. You may be treated resident in India even though you are working from the soil of outside. So permanent establishment provision may be captured your apportionment of Indian revenue tax in India. So equalization levy is there in the Finance Act 2022. 2% equalization levy provision is there. May also apply as the sale and purchase of digital asset may amount to facilitation of e-commerce supply or services carried out by exchange operation outside India. It may be case you are a foreign company, you don't have any PE in India. In that scenario, 2% equalization levy may be levied to you. So it will be best for you, you remain resident in India. So now we come to crypto trader. The crypto trader who is the Indian investor will need to pay 30% tax on transfer of cryptocurrency, but they don't allow losses offset against their income. Moreover, as a buyer of crypto trader, you have to withhold 1% as TDS in respect of buying cryptocurrency. Now recently from the 1st July 2022, now government has come out with Section 194S only in respect of buying from resident. If we are making payment to non-resident or foreign company, so that in that case Section 195 play important role. Banker will not allow to you to make a foreign remittance without compliances of 15CA 15CB. So in respect of Section 194S, government has already issued clear binding nature circular. The Section 194S says government CBDT will issue a circular guidance that will be binding upon department as well as the assessee. So this circular is binding nature, you have to follow that. But there is a silence over the foreign payment for which transaction is covered. 195 is totally not clear, not covered by that circular. So I urge from the government also, as soon as possible they should come out with clarity over the section of 195 in respect of virtual digital asset. The circular for payment to resident clearly says that in case of multiplayer, if the transaction routed through the exchange, then TDS is liable to be deducted by exchange only. So that exchange should be resident in India. What about that exchange? KuCoin case, your exchange is located in Dubai World Trade Center. In that scenario, there is no TDS liability because you are not resident, not registered, not have a PAN number, TAN number in India. So there are many questions arise whether these kind of exchanges, those are operated through outside India, required to register in India. Those are only providing P2P services. WazirX is providing only peer-to-peer services. So is it they can escape this TDS liability by saying that buyer will deduct or seller will deduct? So this will be picture is in our near future. So exchanges need to file form 26QF. Secondly, in case of simple transaction, buyer and seller, I want to buy USDT from another seller who is the resident in India. I need to deduct section 1% TDS under section 194S, and I have to file form 26QE monthly. There is no need to take 10 number registration. I simply go to the online portal of Income Tax Department and select form 26QE and given a reference the seller PAN number. On that basis I can deduct TDS, and after within 15 days I can issue form 16E. So this is the scenario will cover. Even though in case of exchange of non-primary BDA, suppose you are selling your Monero and want to buy Dazo, then buyer and seller, there will be double TDS deduction liability with the both buyer and seller. However, in case of primary BDA, suppose you are buying Bitcoin, USDT, USDC, which can be easily converted into INR, only buyer is responsible for TDS, not a seller. So we are sure this provision is very harsh. Definitely more and more difficulty will be arise for the buyer to deduct TDS and report TDS without the seller information. The seller information is very confidential. Maybe exchanges will not share seller information to you. So how you report the TDS in that scenario? Another problem. So as per the FEMA, as an Indian resident, person resident in India, you have FEMA responsibility also there. As per the RBI liberalized remittance scheme, LRS scheme, every resident in India is allowed up to 2,50,000 USD for particular financial year. For whole of the financial year, you get exemption up to 2,50,000 USD. This total limit you may be exhausted by way of you incur expenses over the foreign tour, for making expenses in respect of your children education overseas. So they will not able to make an investment in cryptocurrency. This will be uncertainty. So there is no uncertainty in the cryptocurrency exchanges. Virtual digital asset is very clear. You is allowed up to $250,000 per financial year, not over and above. So there may be TCS liability is there. Suppose you are making 8 lakh payment to foreign company for buying cryptocurrency, then banker will deduct TCS also, as the TCS provision says that if you are making foreign remittance under the LRS scheme over and above 7 lakh, your 1 lakh is liable for TCS. So from the corporate angle, you are also required to follow FEMA regulation, since foreign direct investment, overseas direct investment regulation is there. So as per the scenario, you overall see from the angle of exchange, you should not go outside India mere on the basis of uncertainty of tax structure. There is no uncertainty, everything is clear. If you are resident, tax is charged as per the domestic company, as per the Indian income tax. If you become the non-resident by shifting outside India to Singapore, to Dubai, then you are selling your cryptocurrency to resident in India, then still you will be liable for equalization levy, because the equalization levy to foreign company, those don't have PE in India. So in that scenario, your 2% on the entire transaction with the Indian customer, Indian resident, will liable for 2% equalization levy. This equalization levy is not liable if your total transaction is below 2 crore. Let us examine an example how section 195 S195 will play interplay. So suppose you are an arbitrager, you buy KuCoin from KuCoin portal, cryptocurrency, say USDT, and selling at Binance. You are making 1 rupee profit. So in this scenario, your selling rate for 1 USDT is 80. You are buying from resident. Buying cost is 78.2. So you have to deduct TDS on 78.2. It's 1%. So your total cost for buying is 79. So after this your profit is 1%. So sale consideration for 2,50,000 USDT is 20 million INR. But you receive from seller after deduction of 1% TDS is 19.80 million INR. So TDS deducted by seller laying with the income tax department. So this is the cash loss. Your cash deposited with the income tax department in the form of TDS that will be received after filing your ITR. Time gap is 1 year approx. That may be adjusted. That is adjusted with your profit, taxable profit. So in this scenario, the sale consideration is 20 million INR, right? And your buying cost is 19.75 million INR. So net profit is 2,50,000. But your cash profit, cash with in your pocket is 50,000. So let us understand how this section 194S and 195 will play in this scenario. Suppose you are buying from non-resident foreign company, then you have to comply FEMA regulation. All payment should be routed through proper banking channel. You must have your TIN number for the purpose of TDS payment. Before making foreign remittance, you must get a CS certificate in the form of form 15CB and make a declaration in 15C. For TDS filing, you must file form 27Q quarterly and issue form 16A. So this position is not covered by the circular number 13 in respect of section 194S, because the section is implemented in respect of you are buying from resident, you are making payment to resident only. So this will be the difficulty the user must understand. If you are making foreign remittance, the section 195 is play important too. So in respect of domestic transaction, you don't need any TIN number. Your PAN number will suffice the purpose. No need 15 CSAV. Only by filing 26QE monthly and issuing form 16E within 15 days of filing return, you can deduct TDS. So under this scenario, let us example understand. Your profit, net profit is taxable as 2,50,000. So as per Indian scenario, up to 2,50,000 there is no tax, right? But TDS deducted by seller is 2 lakh. So ultimately this 2 lakh become your refund. You must apply for lower rate TDS deduction certificate, because if you don't apply whatever the only single transaction in particular year, the 1% TDS useless deposited with income tax department. So this may be important example all of you. But in case you are regularly dealing in cryptocurrency, you are regularly arbitrage profit loss will not allow your whatever the net profit, buying cost, selling cost minus buying cost, the net profit will be either taxed under the profit gain as business income, or if you are treating as capital asset, then it is a capital gain. So ultimately your cash profit sitting in the form of TDS with the income tax department by introducing of section 194S. Because the main buyer in India, if you are switch your door to UAE, then you are looking customer seller in India, then your equalization levy is there. Your whatever the transaction routed through your exchange, 2% equalization levy may be liable for tax, but it can be managed as P2P transaction, but department has to issue clear notification in this regard. How the P2P transaction income tax department is looking at. It is saying wrong if you are say there is a tax uncertainty in India and legality of cryptocurrency in India. Everything is clear now. TDS provision is very clear, and tax liability in respect of profit gain is 30% without allowing the losses in India. So commission income as far as your is liable to tax in India, you need to do compliances for audit and maintaining books of account. So we need to just check how you treat cryptocurrency in your books of account. So if you are dealing as a business transaction, then it will be taxed under the head of PGBP as business income. So if you are dealing through the your as asset as capital asset, then it will be treated as tax under the head of capital gain. So as per the last budget, the finance minister has reduced surcharge to 15% in respect of capital gain. So I advise, if your capital gain is more than 2 crore, so whatever you liable for higher surcharge 25% and 37%, in case of capital gain there is only 15% surcharge is there. So it's saying wrong, your tax liability would be around 30% plus surcharge become 42. It will be only in case of business income, but if you are treating as capital asset, then surcharge is only 15%, then 30% plus 15% on that around 35% is your tax liability. So certainty is there. So TDS provision is now is clear from 1st July 2022, 1% TDS levied in respect of resident buyer, resident seller. So if you are dealing in case through the P2P transaction, maybe department will come out with CBDT another circular how they will treat P2P transaction regarding that your commission income. That is tax as per the normal taxation in India. So as we discussed, as per the OECD pillar 2 approach, they want to tax minimum 15% tax even though you go to outside India. You can't say I am a resident of Malta, I am a resident of Dubai Free Trade Zone. Free Trade Zone, even though it's outside from the purview of UAE corporate tax of 9%, but maybe in some case this will covered as by the pillar 2 of OECD 15% as per the GloBE rule. So we should remain in India, follow the tax structure as per the domestic provision. Investor liability is very clear, they have to, buyer is liable to tax. So hope so you like this video, and any comment, anything you can write with us. Thank you.